Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending April 4th, 2025. So a very busy week, one that will even likely go into the annals of economic history here with Donald Trump's big show, what he called the Liberation Day, which has sent Wall Street in a tailspin, and of course has been criticized by pretty much every economist in the world. So I could do here like a lecture of 3 hours on why this is a very bad economic policy measure. You'll find lots of opinions online. This approach has been criticized by every economist out there. The way that the calculation was made to come up with the tariff numbers don't really make sense. It's been criticized by everyone and especially by American economists. So we'll go into the details in a few minutes. But if I want to summarize what happened, so Trump is building a wall, and here I'm not talking about the physical wall at the border, but the tariff wall against pretty much every trading partner. Canada and Mexico came up in let's say the least pessimistic scenario here. There's nothing to cheer here, but we did avoid the reciprocal tariffs. The effective tariff rate on Canada jumped from between 0 and 2 to about 5%. So it's a shock, but it's not the shock that other countries in the world are living right now. And now the question is now. So we have some certainty on what Trump had in mind because now we have the data, but now the uncertainty shifts to the rest of the world. So how will every trading partner retaliate on that, and what does that mean for U.S. companies, the stock market, the next steps in the world economic order? So still lots of uncertainty around. But if we go to the returns on the week, this is at the close on a Thursday. So it doesn't look that bad because the first few days of the week were positive. But after 4 days, the S&P 500 was down 3.3% in local currency, 4.4% for the NASDAQ. But as I'm recording this on Friday morning, China has retaliated with tariffs of 34% on U.S. imports. This is about $100 billion a year of the flows. So this is sizable, and also that many U.S. firms have used China as a growth hub over the last decade. Think about Apple, think about Tesla. So just hitting the U.S. where it hurts. This could lead to maybe some potential escalation from Trump, but the world order is shifting here. The one thing that is important to tell here, though, is that this is not the 1930s where we had this wave of protectionism just rise, and most of the world started to do the same thing, close their frontiers to trade. This is the U.S. against the world. Now everyone wants to stand up to the U.S. to retaliate in some form or measure. We're hearing also China maybe blocking investments in the U.S. We're hearing President Macron in France asking businesses to show some solidarity and limit their investments in the U.S. to not give Donald Trump that kind of win. So the world is shifting, but so don't underestimate the ability of the global economy to rewire itself. So I would say that the odds of a recession globally here remain pretty low. The odds of a recession in the U.S. have become the base case scenario. So we think that this is recessionary for the U.S. for sure. There were some numbers floating around that for the average U.S. household, the tariffs announced will amount to about $3,800 a year of extra costs. So this is inflation directly, and $3,800 per average household. This is recessionary for sure. So the odds of a recession are high there. For Canada, we think that the odds of a recession are now lower because we've avoided the reciprocal tariffs, but are still not our base case scenario. We think that we will avoid a recession in 2025, but still very much alive in terms of risk, because what's bad for the US, of course, is bad for Canada because we're so tightly linked in terms of economically. So if we go an update on the tariff, so I think this is the picture of the year, what we have here. Donald Trump holding his big board here. I mean, this is just to explain to you how they came up with the numbers. I think it's important and why it was criticized by everyone. The way that they came up with the tariff numbers doesn't make an economic sense. What they didn't look at the tariffs that were actually imposed by other trade partners. They looked at how unbalanced the relationships were. So let's say, for example, and I'm just making numbers up here. Country A deals with the U.S. and it exports $120 of goods a year to the U.S. So that's 120 flowing one way, and the U.S. also exports to that country and sends $100 a year of goods. So there's an imbalance there of $20. So country A has a trade balance advantage over the US, $20. So they use that $20, divided it by the $100 that flows out of the US towards country A. They say that's 20%. So this is the protectionism that they impose on the US, and it doesn't make sense at all. And that's why you get things that absurdities like putting tariffs on Vietnam and Cambodia, and of course China. There's other reasons, but let's focus maybe on Eastern, South Asia here. There are reasons why Vietnam and Cambodia export much more to the US than they import, because this is what the Western world has done over the last few decades to specialize their labor, to send manufacturing to hubs like South Asia, where we can produce at a lower cost the goods that we consume daily, and specialize in services in the Western world. And this is what's efficient for the global macro. So of course they export more to the US than they import, and by putting those tariffs here, everything that is being outsourced in those countries, now the price of that just rose significantly, because we're talking about tariffs of 45% on Vietnam and Cambodia. This is going to be very impactful for US households, because we're talking about clothes, we're talking about shoes, we're talking about electronics, we're talking about everything in our daily lives here. So that's why it doesn't make sense. Canada and Mexico were able to avoid that, so I mentioned that earlier. But now the chart on the right, what you see is that the U.S. tariffs now went from, the average tariff rate went from about 2% to 22%, so that's the highest level in over 100 years, and this is the widest shock in the history, recorded history of the U.S. Here. So this is very significant what has happened here. So the uncertainty is always the thing that drives the market, or that weighs on the market. Now we have some certainty on what Trump had in mind, but now we have multiple other sources of uncertainty. What are other countries going to do? This morning we got China. Is it the end of it, or is it going to be like an escalation? What will the European Union do? Maybe it's going to hit during the weekend, so maybe on Monday we'll see markets being rattled again. Will we see other deals between other countries that are unfavorable to the U.S.? Will we see the U.S. being marginalized? Likely. So now the reputation of the U.S. Is likely to have been hit with semi-permanent damage here for a good while. So this is why it's so important. Now, maybe if you look at the reaction on Wall Street now, two important charts here. So we've been mentioning that over and over again at the turn of the year, early this year. The U.S. stock market was very expensive based on a historical basis and also on a relative basis. Chart on the left shows you the forward PEs. We're trading at 25 times, very elevated forward earnings recently. Now we're at only 19, and the average over the last 30 plus years is about 16 here. So the market in the US is still expensive on those terms. So trying to catch the bottom here doesn't really make a lot of sense, or at least we recommend that people would be very careful out there, because there could be some more damage here before the market becomes interesting in terms of valuation. On the right, there's the drawdown. This is as of the close on Thursday, minus 12% since the recent peak, which was in mid-February. So we're in contraction territory. This morning market is pointing towards an open of about minus 3%, so that would be minus 15. So we're not yet in bear market territory, but where do you find the bottom when you have such a drastic shift in the global trade, and when what was driving the markets over the last years, which is the theme of US exceptionalism, now has been flipped on its head. I would and we would recommend that you be careful before trying to catch a falling knife here. So the basic principles of investing here are always key. Trying to catch a falling knife is a tricky game. Investing for the long run, when you have lower prices like that, you should be happy. You should see an opportunity to add more, but you cannot beat in the long run just investing regularly every week, every 2 weeks, investing in your RRSP, TFSA, RESP, just investing regularly. So you're going to buy on the way down, on the way up, and this is how you win the game at the end. And if, again, seems very simple, but if you're looking at this and you're starting to worry, that means that likely you're not invested in line with your investor profile. So please talk to your financial advisor or just revise your positioning. It's as simple as that. But I cannot advocate enough the importance of active management. There was this story flying around yesterday of RH, company in the US which sells luxury decoration goods for houses, and most, if not everything that they sell is imported from South Asia, and those tariffs pretty much just wiped out their business model like that, and the stock market punished the company. The stock went down by about 50% yesterday on Thursday. So you need to have portfolio managers that pick the right stocks, that are exposed to the right countries, that have the right business model to navigate through this environment. So active management makes a lot of sense. You need to be diversified. You need to have balanced funds that are active. You need to have some bonds, you need to have some stocks, you need to have multiple geographies, you need to have managers that will rotate the positioning based on what's happening, when it's time to go back into equities, when it's time to go more into fixed income. So this is where the value is added. So if there's ever a time for active management and for balanced funds, it's in 2025. It's always a time, but kind of a crying, a screaming theme here for 2025. You need to have that in your portfolios. So just before ending here, if you look at the data that we had, so just to repeat that the US economy is slowing down already. There's the uncertainty that is weighing on the US economy. But this week we had data on the manufacturing sector, the manufacturing PMI on the left. We're below 50 now, so that means we're in contraction, and the number was even worse than expected. And on the right, you have the new orders component, and as you can see, we've had a strong pullback to lower than expected levels. So we are not seeing traction in manufacturing, and be careful about the headlines when you hear Trump and his administration saying, well, we having news of like $8 billion invested by company XYZ. And so when you dig into the details, you see that sometimes, those are investments that were already announced a while before. Some will never happen, but also the size of the US economy is so large that even some of those investments, yes, they can happen, but overall, big picture is that the manufacturing sector is contracting, the US economy is slowing down, and the slowdown is broadening. So all of this is happening at a moment of weakness for the US economy. So again, be careful about trying to catch a falling knife here. Maybe because when the market pulls back, usually it can be a flash in the pan, but this is looking more and more like a process which could take some time. This is all based on the information that we have this week. Of course, we can have very different things come out in next week if our views, if the facts change, our opinion will change. And of course, we'll keep you posted next week for sure. So what we'll be watching next week, we'll have the Bank of Canada Business Outlook Survey. Their new survey where they inform us of what they hear from businesses and households, and this guides monetary policy. So to have a good idea what they will do when they decide later in April. This is going to be very interesting. So next week we'll have some good information there. And in the US, we'll have CPI inflation. Does it really matter? Because we know that everything that's been announced here is very inflationary. So will the market care how CPI comes out in March? Likely not, but still it's going to be coming out next week. And we'll have the University of Michigan survey, so consumer confidence down the drain. So let's see how it behaves for the latest number here. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content here, please share. And of course, things move so quickly. So make sure that you come back again next week with our take on the world. All right. Thank you. Have a good week.